Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
Right. We are jumping straight into our deep dive today because there's a lot to unpack. First up, the government has just dropped its £250 million fraud strategy. Why you should care? Well, because cross-industry data sharing is about to become mandatory, and quite frankly, your tech stack probably isn't ready for it.
Yeah, almost certainly not.
Exactly. Second, the PRA just handed down a massive £10.6 million fine for UK Insurance Limited. Why you should care? Because a simple spreadsheet double count just proved that M&A activity absolutely does not erase historical regulatory liability.
It really doesn't.
And finally, the FCA is cracking down really hard on the second charge mortgage market. Why you should care? Because just benchmarking your fees against your peers, well, that's no longer a valid defense under the consumer duty.
I mean, the underlying pattern this week really comes down to this one thought. The regulators are promising to step back and let the market breathe. But as this week's massive fines and, frankly, prison sentences prove, if you trip over the basic guardrails, they won't hesitate to suffocate you with enforcement.
Yeah, that is a profound tension right now, isn't it? On one side, you've got the UK's new secondary competitiveness objective.
Right.
Politicians, regulators, they're all publicly stating they want to support growth, encourage innovation, be less risk-averse. But on the other hand, the FCA and the PRA are demonstrating an absolute refusal to tolerate operational sloppiness.
Or consumer harm.
Or consumer harm, exactly. If you are sitting in a retail bank strategy or risk team right now, you are caught right in the middle of that friction.
Yeah, and let's look at how that friction is playing out with, well, what is arguably the biggest systemic threat facing the UK economy today, the industrialization of fraud.
It's massive.
It is. According to gov.uk, the government's new 2026 to 2029 fraud strategy is backed by £250 million. And a huge pillar of this is the new online crime center, which is launching in April 2026.
Right.
And for the first time, we're going to see police, intelligence agencies, banks, and major tech firms forced to work side by side to dismantle overseas scam compounds at the source.
Just to put the scale of this in perspective, reading through the government documents, fraud is now costing the UK economy over £14 billion a year.
Wow.
Yeah, 14 billion. 1 in 14 adults and 1 in 4 businesses have been victims. And for UK retail banks listening, I mean, you are already bearing the brunt of this. You've got the mandatory APP rules.
The authorized push payment fraud.
Right, where customers are essentially tricked into authorizing a transfer of their own money to a scammer. According to the sources, those reimbursement rules returned £173 million to victims in the first year alone.
Which is a huge hit.
A massive hit.
Yep.
The burden has been entirely on the financial sector up to this point.
Which is exactly why this new strategy is so critical. It finally drags the telecommunications and tech firms into the fight. I mean, you've got Vodafone reporting they blocked over 139 million fraudulent SMS messages last year.
That's staggering.
It is. And Meta is now collaborating with the National Crime Agency and the Nigerian police. So the strategy is attempting to build this unified perimeter of defense further upstream. It's essentially an automated electric fence around the UK consumer.
But reading through the FCA's 2026 Retail Banking Priorities Report, it's clear the regulator expects banks to be the primary engineers of that electric fence.
Oh, absolutely.
They explicitly demand that firms continually refine their defenses and prepare for new data sharing mandates.
Yeah.
They want you using advanced technology, like AI, to combat bad actors.
Which aligns perfectly with the Home Office's push for law enforcement to deploy AI against fraudulent websites. The FCA is even launching a supercharged sandbox to help firms innovate safely.
Right. But here's my major skepticism with all this.
Yeah.
Are we just throwing £250 million at a multi-jurisdictional hydra?
How do you mean?
I mean, scam compounds in Southeast Asia won't care about a UK online crime center. And the regulators want this automated, real-time intelligence network. But retail banks are fundamentally hampered by legacy IT.
That is the big bottleneck, yeah.
Right. You have core banking systems that still rely on overnight batch processing. Your 1990s mainframe simply cannot talk to a meta server or a telecom provider's API in real time without breaking.
Spot on.
And that's before we even touch the deeply ingrained institutional paranoia around GDPR. Sharing customer data at the speed the online crime center demands, well, it's going to shatter current compliance models.
And that is precisely the bottleneck you have to worry about. The scam compounds operating in Southeast Asia using forced labor and deploying AI deepfakes, they are operating at the speed of the internet.
While banks are operating at the speed of committees.
Exactly, the speed of their compliance committees. If the strategy fails, it won't be because the £250 million wasn't enough. It'll be because the internal architecture of the banks just couldn't handle the data velocity.
So if I'm sitting in a commercial strategy role listening to this, my immediate priority on Monday morning needs to be assessing my firm's readiness to plug into the upcoming National Telecommunications Traceback Scheme.
Yes.
It's coming by 2028, and it will require mapping the origin of fraudulent communications.
And from a risk perspective, look, you cannot wait for that traceback scheme. You need to pull your APP fraud reimbursement data immediately and identify exactly where your friction-based controls are failing.
Because the criminals are using AI to bypass standard friction.
Right, so your anomaly detection needs to be doing the exact same thing.
Okay, but building that external electric fence against fraud is entirely pointless if the internal wiring of the bank is short-circuiting.
Nice segue.
Thanks. Which brings us to a textbook example of entirely preventable operational failure. Let's look at the PRA's £10.6 million fine for UK Insurance Limited.
Right. So UK Insurance Limited, or UKI, was the principal underwriting subsidiary of Direct Line Group. And between June 2022 and August 2024, they had a massive miscalculation in their solvency test and balance sheet.
Specifically around a reinsurance arrangement they called Project Athena.
Yeah, Project Athena. Now, solvency second reporting is notoriously dense, but the core mechanism of this failure is shockingly basic. Project Athena was a 10% quota share reinsurance arrangement. But according to the PRA's final notice, the firm essentially double-counted an asset.
Wait, they just counted it twice?
Basically, yes. They accounted for it once as a standalone asset, and then they failed to remove it from their technical provisions. So they essentially counted it again as an offset.
Unbelievable. And the consequence of that double count was severe, wasn't it?
Massively. It meant they overstated their solvency capital requirement coverage ratio to both the market and the regulator. By year-end 2023, they reported a ratio of 170%, when the actual underlying figure was 161%.
Wow.
That is a £99.9 million overstatement of own funds.
It's like failing your MOT because you counted the spare tire in the boot twice and confidently told the mechanic you were driving a six-wheeler.
That's exactly what it is. It's a fundamental failure of basic arithmetic. And because the PRA relies entirely on accurate quantitative reporting templates, the QRTs, to monitor financial health, getting that maths wrong compromises the PRA's entire objective of market safety.
Right, so they found UKI breached Fundamental Rule 6, failing to organize and control their affairs responsibly.
Yeah. But what is particularly alarming are the root causes the PRA identified here. They cited stretched finance functions.
Always the excuse.
Exactly. Resourcing issues, a lack of staff training, and crucially, a solvency SICIP manual that was far too high level. It completely lacked the granular step-by-step instructions needed to properly map these highly complex reinsurance transactions into the reporting templates.
I find this fascinating, especially when you look at the recent parliamentary debates recorded in Hansard. The House of Lords has been heavily debating the secondary competitiveness and growth objective for the PRA and FCA.
Yeah, the new mandate.
Right, and the Chancellor actually suggested regulators should be, quote, less risk-averse and move away from the comfort blanket of operational efficiency.
Which sounds great politically, but this enforcement action is the PRA drawing a hard line in the sand. They might theoretically support market growth and structural innovation, but basic prudential reporting is completely non-negotiable.
You cannot innovate your way out of an inaccurate balance sheet.
Exactly. Saying we didn't have enough staff is just not a valid defense for a £100 million reporting error.
There is also a massive warning here about M&A liabilities in there.
Oh.
Aviva acquired Direct Line Group in July 2025, and by doing so, they inherited this massive compliance headache.
They bought the liability.
They did. Acquiring a firm does not wipe the regulatory slate clean.
Yeah.
You buy their historical sloppy data alongside their market share.
Absolutely. Though we should highlight the financial mechanics of how this penalty played out, because it introduces a major new dynamic for the market. UKI originally faced a £21.25 million fine, but they utilized the PRA's new early account scheme, the EAS. This was the first time it has ever been used. Because they provided a fulsome, candid account, and made early admissions before the PRA even proposed a settlement, they received a 50% discount.
Which changes the calculus for compliance teams entirely. If my risk function uncovers an undeniable regulatory breach tomorrow, the financial incentive to self-report and cooperate via the EAS is immense.
It is institutional self-snitching.
Yeah, and it works. So, on the commercial side, next week, if you are launching complex new products or executing corporate transactions, your manuals must contain granular, step-by-step regulatory mapping. No high-level fluff.
And your risk and audit teams need to scrutinize the resourcing levels within your finance and actuarial reporting functions immediately. If your teams are consistently described internally as stretched, you are a sitting duck for a fundamental Rule 6 breach.
If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
So we just saw a firm penalized heavily for getting the fundamental maths wrong on their prudential reporting. But that exact same lack of rigor becomes significantly more dangerous when it bleeds over into how you treat consumers.
Yeah, which takes us directly into the territory of conduct rules. How does the regulator balance its pledge to step back with its mandate to protect the vulnerable?
Well, David Giel, the FCA's Executive Director of Payments and Digital Finance, recently gave a speech at the Money Love Summit. He explicitly said the FCA is looking at where it can step back and reduce complexity to give firms room to innovate.
He even quoted Einstein, didn't he?
He did, about finding simplicity out of clutter.
It's a great soundbite. But
Yeah.
the reality of that balance is laid bare in the FCA's concurrent review of the second charge mortgage market. They published a highly critical report on lenders and brokers in this space.
And just for context, second charge mortgages allow homeowners to borrow against their property's equity without changing their main mortgage.
Right, it's a very small market, under 4% of regulated mortgage sales, but it's heavily used by customers who are trying to consolidate existing debt.
Which means the baseline customer in this market often has high existing debt and low financial resilience. They exhibit clear characteristics of vulnerability. And the FCA found a litany of poor practices.
Like what?
Well, affordability assessments that entirely overlooked key living expenses. Advice that steered customers into debt consolidation without actually addressing the root causes of why they were in debt to begin with.
But the mechanism that really caught the regulator's eye, and the one that should terrify mainstream retail banks, was the fees. The fees charged by intermediaries were typically more than 10% of the loan value.
10%.
Yeah, and the way firms were justifying these massive fees under the consumer duty is a masterclass in missing the point.
Because the consumer duty mandates fair value assessments, or FEAs, and the FCA found that firms were heavily relying on benchmarking to justify their 10% fees.
That's completely circular logic.
It is. The mechanism was literally, they looked at what their competitors were charging, saw it was also around 10%, and concluded, well, our fees are market average, therefore they represent fair value.
How can a retail bank confidently innovate or step back when the FCA is retroactively tearing apart their fair value assessments? The insight here is that the FCA no longer views market average as an excuse for poor value.
No, you have to prove the underlying mass of your own overheads. If you charge 10%, you need to prove 10% worth of labor and consumer benefit.
Exactly. Some of these firms tried to justify the costs using an hourly rate, but when pressed by the regulator, they couldn't provide any task metrics or rationale for the time taken.
They claim the debt consolidation cases were highly complex.
Right.
Yet the FCA noted many recommendations were being made within a few hours on the exact same day as the application.
Unbelievable. Firms are clearly still treating FVAs as a compliance tick box exercise. The FCA expects a genuine, granular calculation of staff costs, overheads, and tangible consumer benefit. You cannot just point at the broker next to you and say, well, he's doing it too.
Yeah, if your underlying operations don't mathematically justify the margin you are taking from a vulnerable consumer, your FVA will fail.
Which means strategy teams cannot rely on competitor analysis for their FVAs anymore. You must justify consumer fees using specific task metrics and internal overheads.
And for risk teams, your quality assurance on anything involving debt consolidation has to be overhauled next week. You must have documented proof that your advisors are discussing the root causes of a customer's debt, rather than just rubber stamping a high-fee loan.
But look, when corporate governance and fair value assessments fail, you get regulatory warnings and civil fines. What happens when individuals within the system show a complete, deliberate lack of integrity?
Then we transition from corporate liability to personal ruin.
The sharp end of enforcement. The FCA announced some incredibly severe individual penalties this week. First, Kasim Garipoglu, the owner of an online FX trading firm, was banned from UK financial services entirely for a staggering lack of honesty.
Staggering is the right word. Between 2012 and 2022, he consistently prioritized commercial advantage over regulatory requirements, basically viewing potential fines merely as a cost of doing business.
Right.
But the specific mechanisms of his deception are wild. He provided false information to regulators. He forged a document to pretend an employee lived with him. He falsified a university degree for himself.
And he even instructed a colleague to impersonate him on a phone call to the South African regulator.
Which is insane.
It is. But the detail that really highlights the absurdity here is that he literally had his staff take a mandatory anti-money laundering test for him, pass the certificate off as his own, and then lied about it to the FCA.
Unbelievable.
Is the equivalent of sending your mate to take your driving test while you are operating a taxi firm.
It is entirely absurd, but it highlights a critical mechanism of the senior managers and certification regime, the SM&CR. The FCA is meticulously focused on the actual fitness and propriety of individuals wielding power. And if you think Garipoglu's ban is severe, look at Rajinder Gill.
Yeah, Rajinder Gill was jailed for 2.5 years this week. He ran an illegal, unauthorized sale and rent-back scheme through a company called Secure Property Consultants Ltd.
And a sale and rent-back scheme is where struggling homeowners sell their property at a massive discount with an agreement to stay on as tenants.
It's a high-risk product of absolute last resort.
Exactly, and providers must hold FCA authorization. Gill did not. He deliberately targeted vulnerable homeowners facing financial difficulty, charging excessive, confusing, or hidden fees totaling over £925,000.
And some of these victims were ultimately evicted from their homes entirely.
Yeah. And when he found out the FCA was investigating, he actively tried to shut the company down and instructed his clients not to speak to the regulator.
If we connect this back to the beginning of our deep dive, Gill's exploitation of struggling homeowners perfectly mirrors the predatory tactics of the overseas scam networks we discussed in the fraud strategy.
It really does.
The difference is he was a domestic actor operating right here in the UK, deliberately exploiting the regulatory perimeter.
And that is the crucial takeaway for a mainstream retail bank. You might think, well, we aren't running illegal property schemes, so this doesn't apply to us.
Right.
But retail banks frequently use third-party introducers, lead generators, and fringe partners to drive mortgage or credit business. If those third parties are operating just outside the regulatory perimeter or using aggressive tactics on vulnerable consumers, your bank is entirely exposed to reputational contagion and severe regulatory blowback.
You cannot outsource your regulatory perimeter risk.
Never.
So if I'm auditing my commercial networks next week, I am mapping out every single third-party lead generator and introducer attached to the bank, verifying they hold the correct current FCA authorizations.
And internally, risk teams need to conduct immediate spot checks on SM and CR fitness and propriety declarations to ensure absolutely no corners are being cut in mandatory compliance training. You do not want a Garipoglu situation hiding in your ranks.
Definitely not. Well, we have covered a vast amount of ground today, from the macro strategy to individual criminal enforcement. Time for the 60-second recap.
Go for it.
Here are your top 3 takeaways from this week's sources. Number 1. The £250 million fraud strategy demands immediate preparation for cross-sector data sharing. Your legacy IT batch processing needs to be upgraded to handle real-time intelligence.
Spot on.
Number 2, accurate prudential reporting, like Solvency II QRTs, is non-negotiable. Resourcing stretch is not a valid defense for a £100 million accounting error. Number 3, under the consumer duty, fair value assessments cannot rely on mere industry benchmarking. You have to mathematically prove the cost of your overheads against the fee you charge.
And your 2 watchouts. First, if you discover an internal breach, the early account scheme is now a proven mechanism. Being candid and early can literally have your fine, as we saw with UK Insurance Limited.
Huge incentive.
Second, the regulatory perimeter is heavily guarded. Expect criminal enforcement and actual jail time, not just civil fines, for unauthorized perimeter breaches and severe integrity failures.
Before we go, I want to leave you with a final thought to mull over. We talked at the very beginning about that new online crime center building an automated electric fence against fraud, deploying advanced AI to spot global patterns in real time.
Yeah.
If the government and law enforcement are demanding that kind of predictive, data-hungry AI capability to monitor external threats today, how long do you think it will be until the PRA and the FCA use that exact same AI technology to proactively plug into your systems and audit your internal regulatory reporting and affordability assessments in real time. That electric fence we talked about earlier, it's about to be pointed in.
That is a very sobering thought to end on.
That's all for us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp, stay informed, and stay compliant.